What's up, everyone, and welcome to another episode of Tuck Notes, Beginner Stock Talk. My name's Tucker, and I'm your host for this channel. Today, we'll be talking about that strange new word that we're learning, Ichimoku Cloud. And what is it? How does it impact us? To the plus or the minus, when to buy in, when to get out. I'm going to try to cover all of that with these different photos I've been making on Instagram and then kind of cropping it and then adding some words and arrows and stuff. So I'm a visual person, so maybe there's some other visual people too. So this is first what it looks like, the word. If you're going to be typing in the search engine, Ichimoku, you want to get fancy, kinko kayo. And what I wrote down here will pertain to what I'm going to talk about, but the more times it gets tested within a short period of time, the greater likelihood it will break up or down. But I'm showing you the down part, and then we'll go into how to enter a breakout right before it breaks out. And so the first step, I don't want to get into that, but we will, but you can see this first step is to go to a 4-hour time frame, and then tight consolidations. The tighter consolidate, the more greater and likely to go lower or higher depending on the graph. So now to our visual aids. I drew one, but I'll show you what I have over here on that. But just to visually see it from a pencil perspective, this is what I drew of, I forgot what coin or asset it was, but this is the distribution phase right here, and you can see as it gets distributed. And then there's, I forgot that part, what that part's called, but after that it goes down. It has a little like elbow, and then it hits really hard, and then it pops back up, and then it has this weird squiggle that's very distinct with a sharp corner turn back up and goes down, and then it has that weird sharp corner again and goes back up. And but then it is in this part right here, this is when you see on the, I'll show you what I'm talking about on the graphs in a photograph, hopefully in a minute. But it's this part, that squiggly part, that's what I'm trying to, or actually it's not the squiggly part, this is the razor part where it looks like kind of like, but it's really tight. It's like, or like that. So that's that going down before it does this weird push, and it just pushes through the resistance on this side and on this side, and follows the money flow, and then it is going down, downward trajectory. So we've got momentum pushing down this way to make this happen and go up. And then it has 2 ears up here. That I found out to me is like an indicator that it's going to drop. So get out when you see that, come back in when you can see this to go up. And that's Tuck's visual aid. Now I'm going to show you on some photos on my iPad of what it looks like. And this is the first, this is what the cloud looks like here. This whole area, this is the cloud. And what happens is people will buy a stock and here, write it up here, and then sell it, and then think, oh, the stock's going down. They see it's going down, and they panic, but they don't know if they're in the cloud, so they sell. Or they sold here, and they don't know whether the stock's going to go up or down. And so resistance levels is what keeps these lines where they are. So now these are the fingers. You have one chance to buy, one opportunity, kind of a 2, definitely 3, 4, 5. There's usually 5 fingers on the cloud. And then when you want to get back to normal, look, this is the base of the cloud. This is like at the bottom, and it's a little bit higher than what you bought it at. So you could just do a crazy swing trade up here, get your money, hold it for a day or 2, and then come back down and buy in again and do the same thing. This is what I found out. The kijin, this is something you should Google and check out. This is what I've been trying to talk about the entire time. I didn't know this is what it was called. But so here's an example of a stock crashing, right? And it catches it here, but then it eventually falls and hits the floor. But then it has an automatic rally for the people that buy it, because they think that's the lowest it's going to go. So it goes back up. This is just human nature doing this. And then they sell off and go back down. But it went a little bit higher than the previous, and that's not always the case. But as you can see, with this momentum, with this situation, the pressure's gonna go down again more. It would be different if it was not a mountain up here and it would be something else, down below. And so this is exactly what I'm saying. This is the resistance lines. It wants to go up. We think it's going to go up, but it doesn't. It goes down and then down and then down. So what I learned on the video, just watching this before I made this, is that right here is a good buying opportunity, because we already know it's going to go down, and when it goes down, it's going to go back up. If this is the consolidation part, we don't have much information other than this right now. But if we do, and you can just change your time frame to a different time frame. Now, spend some time on this one. This is Tesla. And so think of pressure as one direction pushing, or think of pressure pushing one direction and pressure pushing from the other direction, and you're going to get a reaction, whether it's going to go this way or that way. And so I'm pointing out here in these 2 white arrows where these are like symbols for us to know what they look like, because here's what happens is it comes up like this, and then it hits like a floor or a resistance, and then it has this little M shape right here, and then it goes down like that, and it has that little curve, and this little curve is your indicator that where you can say if this is lower and this is higher, we could see this eventually go up, because it's up here, this one's higher, this one's lower, and so you get like a spring effect, and that's what this is. And then bring out picture, it's a chain reaction, and then you're just slowly in a long accumulated phase before it jacks up into distribution, and then this is when you'd want to sell and then take your profits, or along the ways, whatever way you want. But I want to point out right here that this is the double bottom. It's not a curve, it's on an angle, but this is what the double bottom would look like. And then there's a drop after that, and then that's when you'd want to buy it. After the double bottom is a good time, or after the automatic rally. Last example I'm going to give you is Microsoft, and here's a picture I just took today, how to spot a breakout before it happens. Here's those curves again, there's one, and here's the other. It's higher, and this is lower, so what happens? It goes up. And then right here, I can zoom in, tell you where I'm pointing exactly. Oh no. This is another example of it going like this. One check here, one check there. This one's lower, this one's higher, so it's going to go down. And then along this path right here, it looks like a big long spider. In the dead center is this little nub right there. And that's the breakout of the beginning of the Ichimoku Cloud coming up into its fingers. And so we'll see what happens tomorrow in regards to that. I know it's a long video, but I hope you watch it and get something out of it. What I'm trying to describe is really important to understanding when to get in and out of a position. So if you like the video, push the like it. Follow me on YouTube at Tuck Notes, and on Instagram at TuckerML. See ya.